Welcome to Money Insight, your go-to channel for all things finance. We provide the latest insights, tips, and strategies to help you make informed decisions. From personal finance to investing, we've got you covered. And we are back to reveal 7 secrets of the banks. Almost 100 years ago, Henry Ford came out and said that it was good that majority of Americans were not aware of how the banking system works because if they were, there would be a revolution. Although it has been many decades since Henry Ford made that statement, it is as true today as it was then. We are not saying that banking should be abolished. Not at all. Banks provide us with services that are very useful. Banks are an essential part of our financial lives, but there are hidden secrets in the banking sector. Everyone wants to know that their money is where it's safe and secured. It probably wouldn't be a great idea to put your money under your mattress, and you certainly don't want to dig a hole in your backyard to bury your money. But you should know that banks are cashing out, and the cash out is being done at the expense of the unsuspecting public. But because the structures of the financial institutions are complex and they operate rigorously, unusual practices are not easily detected by the public. This will affect you regardless of your outlook because we all utilize one banking service or another. Whether you take a loan, use a checking account, save your money at a bank, or utilize any of the numerous services that banks use to make profits off of you, you are being milked unknowingly, and that needs to change. In recent times, bank stocks have become an investor's delight. Could it be because of the multiple income sources that banks have at their disposals? Let's look at some truths about your money that banks don't want you to know. The first truth about the bank and your money is that you lose money every year that you save your money in the bank. Your grandmother probably told you that the bank is the best place to keep your money, and no one has told you that it is not true, that you lose money over time when you keep it in the bank. This is not just about the fees that you pay on your spending, but more about the next to zero interest rate and inflation. Simply put, inflation is the increase in the prices of goods and services, which means that you will need more money to buy the same thing that you bought yesterday with very little money and even much more in a few years. Every investor wants to keep up with inflation, but this is not always the case with bank accounts. For example, if your money in the bank yields 0.05, it means that you will be losing up to 1.95 on the value of your money every year. This is money that you have in the bank, which should increase in value over time because of interest, but inflation supersedes the interest rates many times over. Number 2. Every time you swipe a credit card or debit card to make a purchase, the banks make money first. You may not be aware that banks earn money from processing fees as you were just debited for your actual purchase, but the merchant is responsible for paying the fees. If the merchant is charged 3% on every payment made with a credit or debit card, it is the bank that receives that money. The merchants include these fees in the sales price because they don't want to lose that money, so the cost is passed on to you, the consumer. In the end, you paid 3% more than you should have just in fees. Given that most individuals prefer to pay with their cards, the banks are making a killing and you, the consumer, are absorbing all the fees. Additionally, because the bank earns so much money from your credit card, they provide numerous incentives to entice you to apply for one. What you probably don't know is that the interest rates on your card can be increased at any time. The average interest rate on a credit card is 17%, but your bank may decide to raise it up to 18% or even 19% after only giving you a 15 or 30 days notice. Frequently, you don't get to read these letters that are written in complex legalese because you choose to ignore them, which allows the banks to get away with it while profiting from your ignorance. If you have compound credit card interest, this will eventually work against you. If you don't pay off these debts, you might be headed for financial trouble. However, the credit card is not a bad idea in and of itself. For most of us, using a credit card is a convenient service that has become a part of our everyday lives. But caution should be exercised to avoid building up debt. Make sure to pay off your credit card debt each month. Number 3. Your money in the bank is not physically in the bank. You could have millions of dollars in the bank, but you are just seeing the figures and electronic records. This is due to the fact that banks use your money to conduct business. They lend it to you in form of mortgages, business loans, and auto loans. Despite the fact that your money is deposited with the bank, it is actually being used elsewhere to generate further income. In reality, Your money is earning extra money for the bank in other places. Essentially, your savings is a loan to the bank to do with as they please. This was the reality for many in 2008 during the Great Recession, when panicked people went to the banks demanding to withdraw their money, but the banks did not have enough money to pay everyone. During a crisis, if everyone were to run for their money, the physical cash is what will be needed and it will not be available. This is due to a policy known as fractional reserve banking, which permits your bank to lend money to people in the form of loans and mortgages. Does this mean that banks are not safe places to keep your money? It may be a safe place, but not the best place. Your money in the bank is insured, and the government is ready to step in if something goes wrong, or at least they should be. When you go to sleep at night, remember that your money in the bank is not working for you, and that there may be a time when you will not be able to access it when you want to. Instead, your money is working to make money for someone other than yourself. Number 4. Bankers are not your friends. If you believe that they are your friends because they know you by name, frequently call you to chat up, show that they love and adore you, remember your birthdays, and celebrate your anniversaries, you are mistaken. The reality is that they are merely acting out a well-rehearsed script while waiting for the right moment to strike as a banker. Bankers will gain the trust of a customer by doing all the things I stated before, giving the impression that they are friends, and then convince them to take a loan that they were not even contemplating. Bankers do the biddings of the banks, and they have quotas to meet, or their positions could be in jeopardy. Number 5. Foreign transaction fees are another method that most banks use to make advantage of their customers. Your financial institution may not inform you of this, but using your credit or debit card to make purchases while traveling outside of the United States will result in additional fees. Next time you travel, take a closer look at your bank statement. If you make purchases with your card, the fees will be there. Most banks won't tell you all of this because if you did, you may leave them and use different payment choices. Certain credit card programs offer coverage in some countries outside the United States. In this instance, using your card in these countries will result in no additional fees for your transactions. Number 6. Regularly review your finances. If you find a charge that isn't yours, report it to your bank right away. If you report the charge within a 90-day time frame, by law, your bank has 48 hours to return the money to your account. Your bank doesn't like you to know about this policy. Know your rights and don't be too busy or too lazy to check your accounts frequently. Number 7. You are being watched. Banks monitor all of your financial transactions and are required by law to alert the IRS to any suspicious financial activity. This policy was implemented to prevent shady transactions like money laundering. Depositor withdrawals exceeding $10,000 are also reported to the IRS. The Internal Revenue Service will issue queries requesting an explanation for such transactions if an audit of your account is necessary. First, the authorities want to determine whether you pay taxes on the money. Second, they want to know if the transactions were carried out legally. Knowing that you are being monitored when handling money will help you avoid difficulties and remain out of trouble. Thank you for watching Money Insight. Hit the thumbs up button if you learned something from this video, and check out the next video shown on the screen. Remember to subscribe and hit the notification bell for more content.